Hello, everybody. Welcome back. Friday morning here in the United States on the East Coast. I made a trip to New York City, so out of my Florida element a bit. Very cold up here. I was struggling yesterday walking my dogs in Tampa at 52 degrees, so it's about 30 something here. So I'm really going to struggle today. Um, but got a lot of good stuff to talk about. I encourage you to make a list and a request to be a speaker and ask some good questions and comments. We've had a lot of good discussions this week on Twitter and about numerous topics, so we should get into those. I can't emphasize enough that participate in the Twitter with Rich and me and Michael and Absolute, top traders, and you'll have a good time and you'll be ready for this conversation. So we can take it off Twitter, where we're limited to our ability to type and to express ourselves and go crazy with talking to each other and discussing these issues at length. So Richard had a good speech that I posted, and I tweeted a lot of his comments, and they were all very good. And then in the last 24 hours, we got into this discussion on incentive fees versus management fees. That's kind of fun and interesting. And I posted a lot of tweets about a podcast that I listened to this week that was kind of taking hits at classic trend following. And turtles was mentioned. Everything except my name was mentioned, but that's fine. And could be something we could discuss as well. Oh, yeah, the most important thing that I read this morning, no beer in Qatar for the World Cup. Wow. I went to the World Cup a couple of times, and I remember France in '98. I was at the World Cup, and I drank a beer. And halfway through this beer, it took me that long to realize it was non-alcoholic. I was horrified. Oh, my God. So I could just imagine going over there and having no beer at all. What's the same thing? Non-alcoholic. It's pretty much the same thing. Hello, Oleg.
Hello, Jerry. Hello, guys. I'm very happy to be here. Of course, I can say always only this because it's from the bottom of my heart. And these few days wasn't very happy for me, not because of trading, of course, because trading is always happy. In my own circumstances, and adding to all this, my own circumstances, my relationship. Um, uh, with one woman. In adding of this, my hometown was attacked by the drone this night. But I understand that I'm a very happy person, that I have, that I love, that I have this trend following discussions, as I say, have this trend following strategy. And I'm a really very happy person, and a lot of people don't understand me, why I'm so happy. But for me, it's very happy when you love something, and when you are close to this, when you have such great teachers, such great friends. It's very, very meaningful for every person in the world, I think.
Hello. Good morning, Absolute.
Hey, good morning, Jerry. Good morning, everybody. Yeah, so I think we discussed a few topics this week, as you said. So I didn't write them down, but I guess if my memory will be refreshed in time. So the last one I think we talked about was about incentive fees, and yeah, I've always had this. For a long time, I've wondered how the industry converged to this current standard for rewarding managers for managing other people's money. And yeah, because I've been in the industry for a long time, and it always, for me, it looked like it's a little bit skewed, the reward that the manager participates with an incentive or a performance fee with the upside, but has no skin in the game on the downside. And I wondered, how can this be in a free market? I mean, if the market is really free, wouldn't a more competitive scheme be more attractive to clients and customers? So this, to me, looks like a cartel-like collusion. And I'm just curious as to, like, to ask other people who've been maybe longer in the business than me, what their opinion on this is, and how the payment structures for funds and for managers became so similar. Not necessarily in levels. Let's say some has higher fees or lower fees, but the nature of them, the quality of them is the same. So I'm just curious as to what other people think about this.
You bring up a good point. I hadn't thought about that one, but it is, to some degree, there's two different worlds. One is this ETF world. Andrew mentions that because I guess Niels came back with an idea of that Andrew should charge a percentage of his outperformance at the end of the year. So 25% of his outperformance of the index. And and of course, Andrew mentions that's not part of the ETF ethos. And there is an ETF ethos. And as kind of a joke or messing around, I calculated what Andrew would pay an incentive fee if he charged 20% or 2 and 20 or something like that. It would be 2,000 basis points or 3,000 basis points. Just as a shocker, because for a CTA or a hedge fund, if you make a lot of money and you get 20% of the fees of the profit, no one converts it back into basis points. Everyone's happy. The manager's happy, and he's up 30, 50, whatever people are up, and everyone's really happy. Even though the manager gets a huge payout, which I have gotten over the years as well, and I have big homes around the country that represent those incentive fees that I've received. So, in full fair disclosure, but converting that incentive fee back to basis points into a world of ETF land and mutual fund land was just kind of funny. And of course, no one commented on that. There's no comments on that. But it was just kind of funny. And I think so. Then when you get into the hedge fund world, where people have said that the definition of a hedge fund is its fee structure or something like that, and is that you also get into this world where rich people take cues and signals from the price of things. So if something is really expensive, it must be great. Cars and homes and restaurants and wine. And if it's really cheap, then it might not really be for me and my rich friends. So I think to some degree, there's a play on that, that if you're in that hedge fund world, that, and you don't really want to send that signal and that message that your fees are flexible or they're cheaper. It's kind of like you're defeating the purpose. I've read marketing books and psychology books that speak to sort of that issue. But I do think that there's pros and cons to this incentive fee debate and versus management fee debate. And I do not think there is very much ethics and morality, except bad ethics and bad morality, if you overcharge, if you get rid of your high water mark. That was in the news earlier this year, one of those hedge funds that failed. What they typically do is just shut down and then come back and start over with a new fund and no high water mark. And sometimes rich people will just blow that off. They don't really care. This guy, he wanted to, rather than going through all that trouble, let's just start out with no high watermark. I'm down 30, 40, 50%. I can't pay my staff. I'll just go ahead and start charging you guys an incentive fee. And that didn't go anywhere, and people acted offended. But I don't think that 0 and 20 or 1 and 0 and 2 and 0, you get those two. It's what the market will bear. It's what clients want. They know what they're getting into. There's pros and cons of both. I don't see either one as morally or ethically superior. Do you?
No. So I mean, it's not a hang up. For me, I don't see the dichotomy or the problem whether management or incentive fee is better or more morally right or wrong. Or I think there is room for both. What my question was more about the incentive fees, the asymmetry of the performance fee. So oh yeah. First, I had a comment about this. Was a very good point you made, Jerry, about the what the goods that you described that are actually more attractive the higher their price is, and which rich people use to signal their wealth to others. There's a name for it. It's called Veblen goods. Veblen. Veblen goods, which is a guy who first came up with the concept in economy, which was kind of counterintuitive, for all the economists with the supply demand curves and how the price is supposed to go down with how demand is supposed to go up as the price goes down. Veblen goods kind of revert that on its head, where the demand goes higher, the higher the price is. And there's plenty of examples of Veblen goods like that, especially in the luxury goods markets, where the explanation is the buyers extract utility from the good, not just from using the good itself, but from the signaling they send to the society that they can afford it, that they can have it, and they're in the rare group of people that can have it. So they extract utility from that, from the signal that they're sending to. So you could be right that the richer the clientele, and of course in the private equity and the hedge fund world, the goods and the services that are being sold to them would be more subject to this Veblen goods phenomenon. And that's a very good point. And in terms of my question for the performance fees was like so I also tweeted maybe 2-3 days ago, also in one of the Andrews threads, but nobody responded really. There was this price fee structure with these real estate deals that these guys put up, like the general partners and limited partners, where the general partners have a percentage of the profits, but that's in the end of the project. That's like, let's say the project lasts 5 years, 10 years, and at the end, when we're all kind of exiting and getting out, the general partners get, I don't know, 30% of after fees and expenses and all the profits. The general partners get 30%. And to me, even that 30% is more fair because it exposes the general partners to the upsides and the downsides over the 10 years. And only in the end, when everybody exits or wraps up or retires or leaves, in the end, after all the ups and downs, we leave with 30%. And that's to me, it looks more fair than even 10% of performance, but only on the upside versus the downside, you don't get exposed. So basically, this actually, I think it doesn't align the interests between the manager and the investor because it encourages the manager to be more volatile. This asymmetry of performance fee, this skewness, the positive skewness of where the manager gets a payout on the upside and gets no punishment on the downside, it actually encourages the manager to be more volatile, not necessarily with better risk reward ratio, but even she can just flip coins with huge volatility, even with more than full Kelly. And with this kind of a structure, he's encouraged to just maximize volatility. Because why? So let's say he's just flipping coins. He's up 100% the first year, if he's lucky. He gets 20%, right? So he's up 10 million. He gets 2 million in the pocket. Next year, he's down. He loses it all. He's down 50. He pocketed the thing. And then the next year, he's up again. So he could be up 10, down 10, up then 10 million, down 10 million, up then. So in a row, he can be up and down 10 million in a row, just flipping a coin for 5 years. And he will be extracting money on the ups as long as he breaks above the high water mark. And then we don't know how it ends. In the end, he can be down 80%. Everybody leaves, which is what ends up happening because the venture just get closed when everything goes to crap. Especially if you're close to full Kelly. So basically, this encourages the manager to go full Kelly so that he can extract the maximum amount of wealth from his investors. So I don't think when Neil says that the performance fee aligns the interests is 100% correct. Yes, it aligns the interests to the extent that, yeah, the more money he makes, he gets paid more. But it doesn't align the interest in the sense that his goal is to make the strategy as volatile as possible, not necessarily with the big edge as possible. And the more volatile the strategy is, the more he can extract from the investors. And then the sooner it ends, because after an 80% drawdown in the last year, when he blows up, everything closes down and he leaves with the cash in his pocket and a bunch of disappointed investors to whom he explains, oh, it was a huge year and I wasn't the only one. Everybody was down. Nobody knew this was going to happen. While knowing full well that at that level of volatility, close to flying close to the sun and to full Kelly, he knew it's almost a certainty that was going to happen. So I think that's not ethical. And
I agree. It's and then I think Neil's brought up this idea too that incentive fee is what's required to make sure the manager is doing the best job he can do. I mean, no, that's not true. Everyone here is so petty in this field. They're so particular. They're so competitive. I don't think there's much evidence of that. Vanguard has the best management, has the best strategy of all, and that is they pass along the actual fees, and the actual fees are very low. So Neil's challenged Andrew to lower his fees. Why are you still charging 85 bips now that you're up to $1 billion? Michael, good morning. How are you?
Hi, Jerry. Hi, everybody. Have a nice weekend and a happy holiday next week. A few things. I'm a little confused. First, I would like to, my opinion is let's avoid this fancy term utility. I think the Third World War will start from this term, utility. It's a very vague term to use. There were, many messages on Twitter about this crypto person using this term, and many people try to jump in, and they all got confused. It's very simple, like what Absolute said. Why the luxury goods go up during bad times is because the people who create wealth stop working on projects, and it's their cycle to enjoy their money. Because when the economy is good, they work hard. They work like 15 hours a day. They don't enjoy their money. And that's why the prices go up. It's simple. Let's not use the fancy terms. Everything is like trend following. And by the way, I enjoyed very much the interview with Patrick. I think if you want to put a link on Twitter, everyone should watch the video of your interview. This is Trading Investing 101. Now, Jerry, my question for you, you talked about an index, outperformance of an index, like the DBMF does not track a tradable index. It tries to track an index. So what kind of outperformance we're talking when the objective is to track? Thank you.
Yeah, that's right, Andrew. DBMF, it's tracking the SocGen CTA index, and I'm going to be interested to see how it's doing this month, how he's doing this month as far as tracking. But yeah, Niels proposed that it would be fairer and better for Andrew to charge 25% of the outperformance, and I think Andrew's response was, I would need to charge 50% of any outperformance. Yeah, I'm not sure if that is fair or what, but I think with all of these things, people know what they're getting into. They know the pros and cons. I've had people come up to me and say, I would never do a zero and I would never do a big incentive fee with a manager because of all the things that have just been said. And of course, when there is no clawback, no real type of clawback, there needs to be some sort of clawback, the way that Absolute was talking about it. And historically, when we have, as you know, we manage money in our private funds, we offer clients the choice. You can do fixed fee or incentive fee only, and they get a choice. What do you want to do? And they ask me, you know, my friends will say, what should I do? What do you recommend? And I'm like, well, you're going to pay a lot more if I'm successful. And you're going in, I'm anticipating success, you're anticipating success. So you should definitely do the fixed fee. And that's what they usually do. So there is no great way, but it's just like Absolute said, you need to, and I posted this on Twitter, charge when people redeem their final investment. If you're going to leave me, now you're going to have to pay me my incentive fee. Or if I retire and shut the fund down, collect all the incentive fees. And there can be some interesting ways to get some cash flow out of that. You know, pay half, pay a quarter along the way, et cetera, et cetera. There's ways of doing it, but it's complex, and it's if you really want to get down to it. But it's an interesting debate, and it's just nothing morally or ethical about it, honestly. And nothing's going to make me work any harder or be any better than I already am, and that I want to be. And oh yeah, and the ultimate, as I've said on Twitter, and as people have mentioned, the ultimate alignment is putting my money in the fund, which I do, alongside my investors. And if we lose money, I'm losing more than anyone else. Boy, let me tell you, that's alignment.
And I want to say here that I'm very sure when I first seen this phenomenon of cheap fees, how cheap fees, I saw this, how cheap fees can attract investors with relatively big amount of money. And it was surprised. I thought that people who have few million United States dollars for investing, well, I think they understand something in business. And also, there's another topic, short topic that as I can see, and I even read this in a book, which is maybe 100 years old book, that people have forgotten. I don't remember the author. People have forgotten about the processes. They think only about the money. And it's a very big issue for our civilization, that people see money, want money, but not process of making this money. And really, we are transformed, especially transformed traders, we understand the process. And we understand in all aspects maybe of life, what I say, that the money it's not the process, first of all the processes, first of all, I'm sure.
Richard, are you with us?
G'day, Jerry. G'day, everyone. Sorry about before. I was finding it difficult to get on. But yep, I hope everyone's well. I'll probably stay a bit mute on this performance fee thing. I'd just like to say that, I think it's in the interests of the investors and also the managers that they participate both in the upside and downside. But I do think, it is a question really for investors. Ultimately, the manager decides, what they want, and it's up to the investors to say whether they like it or not. And, they suffer the consequences accordingly. So the recipe, is really sort of, I suppose, decided by the manager and up to the investors to accept it. So if you've got a really solid long-term track record, very strong overall performance, I don't really have a problem with the 20% performance fee at all. But I do understand where Absolute's coming from in there needs to be some penalty for downside.
And this is the following. This conversation made me reminds me of something that Charlie Munger says, that you shouldn't be giving your money to somebody who's not already rich. And if you are just going for size and not for performance fee, I'm just thinking it loud, but you will, like, everybody who doesn't have enough assets under management will be out of the game, because there is a floor of costs that must be addressed, that many emerging managers, so to speak, or people who doesn't have lots of assets will not be able to bear. So in the end, it will end up being an industry. I'm not saying if it's right or wrong, but it will be an industry of people who already have lots of assets under management, like, for example, Vanguard or Fidelity, or I don't know, Winton, etc. I don't know if you guys agree with that. And the second is that if you have a management fee like there used to be, like, for example, when ETFs started for trend following, and still today they charge like 1.2% of management fee, and that it's similar to charging 0.5 and 14 up to a 7% return. So fees have to go much lower, because if you have the mixture of the performance and the management fee, well, yeah, you will pay more if you go above 7%, but you won't pay if you go below, or if you lose money. Of course, that's not a good scenario. And many of these funds tend to be very low volatile funds. So in the end, those kind of management fees tend to be bigger if you adjust them for volatility. Thanks.
Oh, I think, Jerry, excuse me, this debate is more like virtue signaling than anything else. I agree with Richard. This is a free market. You don't like the fees, you take your redemption and you leave. What is this? I think they're trying to start a fund war or something about fees. Come on, if the people that invest with CTAs are professional investors, most of them. And if they are not, they have very good idea about investments, and they can decide. If they don't like it, they leave after a quarter or 6 months. What is this? I cannot understand this frame of mind.
I mean, that's why I started it off by saying the most important part about the discussion is that it's nothing's morally or ethically better. Everyone knows the pros and cons, and there's pros and cons. But yeah, so I agree. It's not and I think I even mentioned a minute ago that it's a free market. You can do what you want to do. And yeah, so anyways, let's move on to the, oh yeah, did anyone besides me listen or read, listen to the clips that I posted from the podcast concerning ideologues versus the pragmatist.
Yes, I did,
Yeah.
Jerry. And I got this impression once I listened to that podcast that they were having a snipe at the turtles. They were having a snipe at those that hold this strong philosophical viewpoint. And I think they were sort of couching themselves as being the pragmatists, and we were being the ideologists. So, no, I think it was an unnecessary snipe. However, it is interesting to me because I hate putting people into buckets. So, they like to sort of a lot of people like to categorize things and put everyone in the same box. And but I'd just like to remind people that it's really the ideologists that probably have had the greatest success in the scientific world as opposed to the pragmatists. So just to understand what the difference between pragmatism and ideology is, pragmatism is a philosophical viewpoint that strongly believes in the philosophy of reason and the philosophy of practical application. So they're less concerned with, if something works or if an idea works, they are right behind that idea. It's a good concept. It's a very realistic concept. However, in endeavours such as science and in trading, I think there is a need for ideology. In other words, people that don't necessarily strictly adhere to reason, people that don't strictly appeal to, well, if it works, just use it. Because what it tends to do is, I bump into characters all the day that say, why the hell do you go into so much detail about trend following? We know it just works, so just shut up and calculate, or shut up and do it. And they get quite frustrated with the likes of me because, I understand where they're coming from. I understand that, if it works, use it. However, I'm always on this quest to sort of understand why. And during this quest, and this quest is, something we experience on Twitter Spaces. We're sharing ideas. It's building our knowledge base. It's connecting the dots. And as you sort of connect these dots wider and wider, you get a much broader appreciation of things and areas to possibly investigate. And so, Einstein was an ideologist, but it was backed up with the fact that he had this viewpoint of the world, which was different to what consensus was. And he was saying, well, there are these exceptions to the observations of reality, which was under Newton's sort of regime. These exceptions, such as astronomical exceptions, the perihelion of Mercury, and all of these things, which said that people were treating them as aberrations or outliers, which shouldn't be considered because they are so sort of seldom in nature, and most of the data confirms to this pragmatist approach. Most of the data confirms to the fact that Newton's theories work, but Einstein refused to accept that, and because he had a wider appreciation, and through his investigation of these aberrations, found a theory that has far wider application across a far wider domain. And this is where I tend to think that whilst a lot of people say, well, the ideologists, they sit on their bottoms thinking all the time rather than doing, and they get quite frustrated with it. I think this thinking time is incredibly important, particularly for things such as trend following.
And I want to say important for me, this topic is important for me because I always say about connection with laws of nature and laws of our trend following trading. And just now, right now, I see the traces of the rain on the wall, and it's look like a chart. And even maybe a week ago, I was thinking about improving some parameters in the system, and I was looking at this, and I looked at this wall, and I see something that looks like a chart, and I began to backtest on this. Really? Backtest on the traces on the rain. It's of course not the full serious backtest, but some thoughts. There was backtesting there. It's not a joke. And I would say that our wider view, I like that Richard mentioned this. I see that a lot of people have the same problem, that they don't want maybe to look wider. As Jerry said, that the skeptical guys have nothing, only their skeptical view, nothing with it. They don't want to look wider on the things. And it's very important to understand, to see the full picture before making a decision. Very important, really.
Yeah, I mean, I think with one of the one of the things with Richard and his tweets and his appearances on podcasts and then the talk he gave, you can go so much deeper and understand what's going on, why it's working, how it's working. You have this community of traders and trend followers, and it helps everyone. Spaces and Clubhouse and all of this stuff. So it really is worthwhile to get into it, regardless of how simple it is. And maybe you'll not change your system, or you'll not necessarily improve your mechanical approach, but it's also, you've got the human element and the ability to stick with what and improve. But what I found interesting on that podcast was there was just a bit of an assumption that the choices that the ideologues make are not worth discussing. There's no reason behind, there's no good reason behind this difference of opinion. It's just they're from the 80s and they refuse to change. And there's a lot of good discussion. And, it's going to come back usually to something like sample size and overfitting and vol management and correlation management and that sort of stuff. But and then I love Mark, and he's very good. And they were encouraging him to talk about the classic trend in the way that he did. And so, but he came from John Henry, who probably was one of the biggest ideologues, and I mean that in a good way. He's disciplined, he's systematic, he's not going to go with the fad. In fact, John Henry had a very unique point of view that I don't know any manager ever having, which was that he never changed his system. So I evolve, and so I'll change my parameters and add markets and try to improve over time, and sort of under this philosophy that what you're buying is Jerry's trend following. Jerry's getting better. He's getting smarter. Hopefully, he's making improvements. He needs to go a little bit longer term, or a lot more longer term in the late 90s. And John Henry was basically, no, I'm not going to change my systems. It invalidates my track record. If I make any change whatsoever, it's invalidating my track record. My track record was from day one, these systems, this time frame, this look back, that's what I'm going to continue to do. And then, and Mark was the president of that company. So, but I like Mark and I like what he writes, and I probably tweet Mark's writings more than anyone else's writings, and he's wonderful. And I don't think he was necessarily, well, he basically, towards the end, he says, the London CTA mafia is more pragmatic relative to the US ideologues, but when trend has done very well, those pragmatists have underperformed the ideologues. The pragmatists have had smoother returns, but they missed out on some big explosive trend periods. I mean, he could have been quoting Rich. He could have been quoting me. That's exactly right. So at the end of the day, Mark rescues us and tells what the facts are, is that, even our approach that makes no sense, not worth debating, is, it has some pros as well as some cons.
Yeah, I think it comes down to this adherence to the back test. So the pragmatist would say, well, if we undertake this back test and it demonstrates the validity of what we're saying, then that is sufficient justification to apply it. No further questions. This is a problem I have because there is something stopping us ideologues from accepting that back test. And there's something sitting in the back of our brain that's saying there's this latent risk hiding in there that no one's seeing. It's not being recorded in the back test. I'm more skeptical of that back test. I've got a process that fundamentally hasn't changed. It still performs as well as the pragmatist's approach. So why the hell change it? Because to do nothing is often better than to do something. So I've got a real concern with this dependency on the back test. I think this is what's separating the quant division from ourselves, from a philosophical standpoint. I just can't. I just know how easy it is to over-optimize based on back tests. I've done it all my life, and I just know how easy it is. And this causes me great concern in this sort of dependency on the back test. A track record, however, a long-term validated track record is a totally different story because one is going forward in time and the other is going backwards in time. So one's going from the benefit of hindsight backwards in time. One's going with no benefit of hindsight going forwards in time. There's a totally different story to be told with this forward test of a long-term track record than there is from the back test. I'm much more in line with taking, significance to me is the long-term validated track record. It's not the back test. Anyone can do a good back test. In fact, everyone does a good back test. You never find a bad back test. So, and that is a process of selection bias and overfitting.
And I think it's execution problems. I think that I think that was for many years I was a short-term trader, and I know exactly that there is especially in short-term space, there is an execution problem, and maybe some transaction costs of trading cost problem. There are some problems, and we maybe will not see this, especially when we are doing our first backtest without any practice. We cannot mention this much, and it's very, very serious situation. So, of course, a track record is more than backtest, of course. And about doing nothing.
Oh, sorry, Oleg. Go on. Sorry.
Oh, okay, but I wanted to say only that interesting idea that doing nothing is better than doing something. But I think that we know that I think doing nothing is better than doing something wrong. And I think in investment, we know that Niels told us that Fidelity had an investigation, a research that the most successful traders are people who have forgotten about their accounts, so they do nothing. So long-term process is always maybe better.
Hello, Bruno.
Mike is here with us. Yeah, hi Jerry, hi everyone. Glad to be here. Mike is here with us, and he brings this point every time, and I can't stress this enough myself. The backtest never proves you're right. It never shows you how good your strategy is. It can only shows you how bad it may be. It can only save you from bad endeavors. Never prove anything. And this debate on pragmatists versus ideologues, where the pragmatists always rely too much on the back test, is only a proof of that. Because when the trend really comes and the trend following moment really is around us, the so-called pragmatists don't perform as well. That's why they trust their back tests for situations that happened in the past that may not that may not happen again in exactly the same fashion. If you rely too much on your back test and optimize too much for the past, you may not exploit the moments in the future that are yet to come.
Well said. Well said. I think it's like two different things going on here. One is this healthy skepticism that Richard is talking about, that no matter how we put it together, we're just like wondering, like, and it's going to impact how we put it together for sure, because we're like, I don't think necessarily that it's going to happen in the future the way it's happened in the past. I've got to be ready for COVID and for inflation in those trades. And so I got to have my loose pants. And I have this healthy skepticism. And I guess there's no way to maybe separate these two ideas, because it is going to have an impact on how you go about designing your system and your back test. But then I think a slightly different issue is the over optimization. So whether, even if Richard and I over optimized, in some way I feel like I would still be very skeptical. Maybe that's contradictory, because maybe it's all the same thing now that I think about it. But I will complain or bring up this idea that I'm not happy with vol management. I'm not happy with correlation management. It's overlay of in something other than one entry, one exit, and a stop loss. Well, I think this is like minor compared to some of the things that we hear about its trend plus some fundamental factors, or um, the environment that we're in. And I think trend just becomes this nice little overlay. And that's just, in my opinion, just so out of control. So I think, to answer the question that never gets asked or hasn't been asked, is that the reason we are these ideologues is because we're very afraid. We want to err on the side, and maybe we're erring monstrally on the side of being conservative, having simple rules that keep us out of trouble, having this healthy skepticism about what we can do going forward, having the loosest pants available, and having the bigger drawdowns. We understand all of this, and we definitely understand why there's a desire to do all of those other things, because no one likes to sit through lots of volatility, lots of correlation, lots of drawdowns. So I understand, and full speed ahead, but for me, I'm a bit too worried and conservative.
I want to say that this over optimization, Jerry teaches this, and it's a very important topic because, and Richard, by the way, said that, as I remember in the last recent interview with Niels, he said that there's a lot of parameters that can bring us a lot of surprises, and I fully agree with this. We must have strong few parameters, and the more parameters we have, the more surprises we can face, and it's I'm sure that it is so.
Hello, hi Jerry, hi everyone else. I mean, last week's conversation was actually an eye opener. You know, we've discussed the fact that these volatility management traders are actually trend following two different time series. So, you know, the classic trend following is to trend follow the price array, or the price time series. And when we say price, we incorporate the open, the high, the low, and the close. So there are actually four different arrays. But just to simplify, just to think simply, we can just say price array, okay, or the price time series. But what the other group is doing when they do the volatility management is they are trend following the price array as well as the volatility array. So they have actually added a new array, a new time series into their models to trend follow. So what this means is, so they are entering with the price and with the volatility, and they are exiting with the stop loss, with the breakout exit, and with the vol. So 2 times 3, there are at least 6 buckets in terms of collecting the data and the sample size. So the question is, you know, And it was an eye opener for me, because first time that I understand that we are not talking about the dynamic position sizing, because when we talk about dynamic position sizing, it's actually, it's just not direct to the point. What is happening is trend following two different time series data, when they do volatility management. And if they incorporate other aspects to it, like the correlation, of course, then perhaps they are trend following more than two arrays. And so it is important to approach the volatility management when we discuss, is just to mention that the classic trend following is just to trend follow the price array, and the managed futures have come to a point where they are trend following two time series. And this, of course, the question is, if this thing works with two arrays, if you can trend follow price array, and if you can trend follow the volatility array, the question would be, would there be something else that you can trend follow? And I think the answer is, they are incorporating this correlation part. But apart from the volatility and correlation, would there be any other array to trend follow? And I've never thought this until we have spoken last week, so it was an eye opener, and it is actually quite crucial to discuss these things so that we can look into it from other perspectives. Thank you.
And I want to say that it's really interesting topics, and maybe almost topics we speak almost always are very interesting. But I think that I want to return here to the point of Richard, that we must have wide view on the processes. And here I think that, for example, breakout system, breakout entry. In 10, 20, 30 theoretical different regimes, in 2000 maybe different markets, it will work, because it's in wide view for this. And some things like this volatility targeting, I don't know. Really, I don't know. I'm not an expert here. I really don't know. But I want to do what I'm sure, what I know. Here's my point.
Okay, Jerry, about this pragmatism and ideologues, so that is a false dichotomy. I don't know. I don't think it makes sense. I would accept empirical versus rationalists. The empiricals are those that do experiments, like back tests and related activities, and the rationalists are those that they use a priori models. They don't question them. They say, for instance, if interest rates fall, I will buy gold, for instance. Okay, but this it's puzzling, this debate, and I think it's also a distracting issue. An unnecessary debate. Pragmatism is something else. Pragmatism cannot be contrasted with idealism. It is only contrasted with foolishness, because pragmatism claims that what matters are the consequences of your idealism that count. Okay, so this is I want to make this point about this debate. I think is totally useless and a distracting issue. Now, as far as overfitting, you can always find an objective function with respect to which every trading system is overfitted. That's another distracting issue. I have examples of overfitted systems that work for 40 years, 4 decades, for 40 years, maybe 50 years. So this is not the issue. The issue is regime changes. And that affects all systems, whether they are overfitted or not.
Yeah, I think it's better to when you have these issues and you want to do a podcast, you just get into it. Let's get into the issue. Like, what's going on here? Why are they doing what they're doing? Why am I doing what I'm doing? And slapping some label on me and ganging up and without getting into the issue. Like, it's like what we do in politics. We can dismiss the other side in this world we live in. We just dismiss the other side. They're bankrupt. They're not us. We don't like them. We don't want to hear from them. So here's the label we're throwing them. We can all in our group dismiss them and move on to what we're doing. And every group in America labels themselves as with the nice label, and they're enemies. But you got to get into it with people and get to the root of it, learn something, and be a better person and improve or not improve. I mean, I can certainly continue to learn something, and that's why I spend time on podcasts that I doubt are going to do a whole lot, but there could be a nugget of wisdom in there as well. And I do like this idea that Alp brought up. It was the 6 buckets. That's kind of interesting. One of the questions I'd have for Absolute and Rich or Alp would be, I think the way they want to approach it is they want to, and I liked Absolute's defense last week. I praised his defense of vol management, vol sizing, and that was good. And but I do think, though, that the way that they traditionally, the CTAs have proposed this idea and written the software is that the software goes through the back test and does each individual trade, one entry, one exit, and a stop loss. Then the money management piece goes over those trades and makes adjustments based upon the equity curve and the equity curve of each one of those trades at that time. Okay, now what Alp and I are trying to do is no. You can do whatever you want to do. You can call it what you want to call it. It's an overlay. It's money management, risk management. You cannot assail it because I've slapped that label on it. But look, no, I'm going to make it into trades. You are doing trades. You've got at least 6 buckets. You have an entry based on vol. You have entries based upon trend. We've even heard them say that the vol-based entries are superior to the trend-based entries. My God, how could that be possible? Then get rid of the trend piece and just do the vol piece. But yeah, the math gods will not accept anything like that. They're going to demand that these are trades. I don't care how you've decided, well, maybe I do care a bit on how you've decided to do a trade, but the vol trade is the same as a breakout trade, and you've got to find a bucket to put it in, and the entry and the exit are linked to each other. What was the entry rule? What's the exit rule? That's the definition of a bucket. Did anybody besides me listen to Rich's speech and him being the professor to the group of people in Australia? And I wanted to ask Rich if he had anything he wanted to add to that. I think he ran out of time at the end, but I thought it was fascinating, and I tweeted a lot of it.
I did listen to it as well, and I thought the seminar should have 3 times more minutes than it did have. So please, Richard, speak to us what you could not due to lack of time.
Yeah, look, I got to this point where I got to a slide where I'd sort of detailed the difference between convergence and divergence. And, when you look at those different regimes effectively, it's almost the exact antithesis between those regimes. So with a convergent model, you have a high win rate, maybe 60, 70%. You can even go up to 90%, So convergent models are focusing on win rate, and they typically have a low reward to risk. Divergent models, the antithesis, low win rate, focus on high, return to risk. So, of course, that difference is because one side of the argument, the divergent argument, is targeting these anomalies or these directional outliers, which, have directional extent. The other side of the argument, the convergent players are trading the repeating pattern, the repeating oscillation, the tendency of a market to operate, for periods of time about an equilibrium. So that sets in place this antithesis in win rate, risk to reward, etc. But then when you look at it from information theory, you can start seeing that in the convergence space, it's what I'm referring to as an information-rich environment. Absolute disagreed with that last week, but what I'm meaning there is we've got a stable regime where things are more certain, things are more known. We've got a single mean, a well-defined standard deviation that allows the convergent player to focus on the back test, the importance of the back test, because they're working on this assumption that history repeats. But then on the divergence side, we're focused on what we're referring to as an information poor environment. In other words, there is no stability out in the tail regions. Distributions start getting chaotic out there. We start losing our grip on this notion of stability or predictability. So we've therefore got to alter our systems to embed system design features as opposed to other methods of managing risk. So on the convergence side, they're using things such as the correlations. They're using things such as the volatility defined in terms of standard deviation variance. They're dealing in terms of that, the typical classic Markowitz phenomenon of standard deviation and return. But on our side, on our divergence side, we're recognizing that risk has got to be handled in a different way. Correlations break down, systems are unstable. We need system design statements such as the initial stop, the trailing stop, to constrain the adverse risk of our systems. Then when we go to convergence side, we see that their models are negatively skewed. This is a symptom associated with the fact that during predictable regimes, they get this, very nice low volatility, nicely sloping equity curve. But when markets start diverging away from an equilibrium, we get these negative skew events, which catch these people off their guard because they're not using the same system design constraints as we are to manage adverse risk. They're relying on the predictable nature of the markets. They're relying on their back test to tell them what correlation should be. And they're working in terms of risk thresholds. Out in our zone of divergence, we don't have that luxury of using risk thresholds. So we're using system design statements to constrain the outcomes to create this positive skewed environment. So we've got negative skew on one side, positive skew on the other side. And the list just keeps on growing. It is the nature of the distribution between what the convergent player is targeting and the divergent player is targeting is just the antithesis of each other. The nature of the market is fundamentally different in both regimes. So, a lot of people will then say, well, then why don't you, consider both convergent and divergent in blended models? And this is where I would then step to the argument about stability. The notion of stability, the notion of predictability, I think is inherently linked to what I call a timing related problem. In other words, we never know how long that period of predictability or stability will occur. When that doesn't occur, the models deployed in that environment, they break down. It's not that, in our landscape, our models don't break down because we've got these system designs that's constraining the outcomes. In the predictable landscape, convergent landscape, their models break down. That's what therefore forces them to abandon their models. And, when you look at the number of participants in the market, so this is where we get another antithesis. In the convergent landscape, about 90% of traders and investors are what I refer to as the extracting arbitrage from convergence. So high-frequency trading, pattern recognition, value investing. The list just goes on and on and on, all based on the principle of they understand where this equilibrium is, where price is, and they assume that price will revert to that equilibrium. On our side, we have no notion of this concept of an equilibrium, because in our landscape we might have many equilibria, many standard deviations, different forms of standard deviation, pathological distributions. So there's 10% of participants doing what we do. There's 90% of participants doing what the convergent guys are doing. And when those systems break down, when convergence breaks down, there's this mass transfer of wealth over to the divergence. But on the other hand, when divergence breaks down, there isn't that transfer of wealth over the convergence, because it's the systems deployed that constrain our outcomes, which mean that we don't revert to convergent players. So, I just thought it's important sort of understanding the principles of those two spectral extremes. Of course, many traders deploy principles of both, so they'd sort of plot somewhere between that spectrum. But out here in this classic trend following land, I think that our focus is 100% focused towards divergence.
Okay, devil's advocate here. Yeah, I agree, but you see, when convergence breaks down, it may break down for 6 months, a year. When divergence breaks down, it can break down for 10 years, like it did between, let's say, 2010 and 2019. So how do you manage this period? You can lose like 15% with the convergence system, because I have traded both. I started with divergent when I first started, and then moved to convergent. And then now I'm moving again to divergent because of reasons I don't want to take your time to explain now. But this is the problem. The other problem is the sample size. Maybe you alluded to that, Richard. It was a good presentation. The convergent systems have a more stable regime, as you said, because the sample size is, the win rate is stable. And a stable high win rate minimizes the risk of ruin. But a low win rate is tied to a higher risk of ruin. That's the divergent systems. So how do you control the risk in the convergent? The convergent strategies, they suffer because you cannot use easily stop losses. So you have to control the risk at the allocation side level. You say, I will use this convergent strategy. I will allocate like 8-10% to that strategy. With trend following, you cannot do that easily. You have to trade all these different markets. The other thing is that flash crashes. Okay, that convergent strategies, they suffer, but a trend following system will not suffer as much. So yeah, I agree more or less with what you said, but the divergent strategies can suffer for a long time, and this is what happened after the financial crisis, the GFC, and until recently. And the convergent strategies did very well in that period.
Yeah, they definitely did, Mike, and I'm not questioning that. I'm just saying that this notion of risk of ruin, I think that convergent players are much more susceptible to risk of ruin than trend followers. So the trend followers, we're using very small bets. We're using the principles of cutting losses short, letting profits run. So yes, we do go through very long, protracted periods of stagnation and building drawdowns. But it would take with my method that I deploy, where I'm when realized equity is getting threatened, I am applying a risk percent basis on my realized equity for my position sizing. So yes, I can go through very long periods of drawdowns, but I am managing the risk through my decreased position size during those periods, because my position is based on trade risk on realized equity. So the convergent player, however, it's just this symptom of negative skew, which I think, and we were talking about regime changes before. When a convergent player comes into a regime change, because their models have been optimized for a particular regime, the predictability and stability of that regime is how they're extracting their edge. When they meet a new regime, which significantly shifts that entire distribution, this is where negative skew arises so fast, with significant consecutive losses of such material losses that brings them to risk of ruin. We don't find that in the trend following landscape. So the programs between 2010 to 2019, yes, they all did suffer. And we got historically, probably the worst drawdowns we've had over the last 40, 50 or so years. Some players got up to about 50% drawdown, but they didn't go out of the game. A convergent player, however, I think is at risk of totally going out of the game when the regime changes.
Richard, excuse me, can I ask you what other kind of divergent strategies would you apply, or do you know, or is it just trend following, the one that goes with divergent ways of trading?
No, look, there are others. Off the top of my head, I'm thinking of buying calls and buying puts, not selling options, but buying options. Where you're putting down a small premium, which is effectively your stop loss, and you're working on the move away from equilibrium, or the divergent move to make your money. That's in the option space. There are a few more strategies, but they are certainly less in number, in participant impact in the market, than those deploying convergent methods.
Thanks, because the other day someone very intelligent asked me, you do that, you do the trend following. Isn't there another way to do that kind of, or having that kind of ideology on the market? And buying options at the end is a game, I guess, I understand, of negative expected value, although it's more precise to cover for unexpected events like the ones you said that break convergent strategies. But I was wondering because I never thought about if there's something else. Thanks.
You can understand trend following as a synthetic way of buying calls and puts, and in a way that your stop loss.
So one more question, Michael. What do you think about combining convergent and divergence? Do you think that's something that's feasible? Do you think that it cancels out, or it's not philosophically sound for one people to do both things?
That's a really, really good question. I don't think it pays. The reason it doesn't pay, I agree with Richard, but I will say that the reason it doesn't pay is that most markets, especially the futures markets, are not mean reverting. But at least by the measures I use. Maybe some people have other measures that they find them mean reverting. And I want to clarify this. Mean reversion is like love. Many people have different ideas what it means. It can be reversion to the trend. It can be reversion to some level. It can be daily reversion. it can be existence of unit roots, rather non-existence of unit roots in a price series. It can be so many different things. So no, I don't think it pays. Jerry Parker has convinced me the only way to make money long term is to be a good trend follower, a disciplined trend follower. And you can have some money in the convergence space for fun, but it has to be a small allocation. And I always make this point in my blog when I write about convergence systems. They are very risky. I agree with Richard. The risk is high. Now, the risk of trend following is what I said. You can spend 10 years making nothing. Okay? I don't know if I answered your question.
Yeah, I was playing the advocates too, because you said, and you're right, that maybe you are 10 years without return on the trend following space, and some convergent strategies are designed just to address that. Of course, you have the huge tail risk that you have to manage. Some people do it with options, but if you mix that, especially when I'm thinking about when you're managing other people's money, right? Because if you have a 10-year drawdown, you will lose many of your assets under management. So I was wondering about combining that, of course, very properly implemented, not something that is very risky, like selling options and not caring about the risk, but maybe combining the two, it could make sense.
Options.
Hey, Mike. Yeah. Wouldn't you entertain the possibility that we haven't seen
Cool,
10 years of convergent strategies doing bad, but they are indeed possible?
Can you repeat doing what?
Sorry, I was thinking, because people say, well, okay,
I think I have
if you
these
have the
issues
problem
with
that you have
Kudera.
long drawdowns on trend following, then you have the complement of a well implemented convergence strategy. And what they mean when they say that is, for example, covering you up with some options to limit your risk, or meaning you are being convergent, but up to a point. And even then, if you have a portfolio of both convergent and divergent strategies, the divergent strategies will almost certainly, not totally certainly, help you up in the worst moments.
I've got my problem with that, Cordura, because if, for instance, we say, why don't we have a little bit of convergence and divergence? And when we say convergence, we're saying, but well-tamed convergence, very, very, very good convergence. So then it comes down to an allocation decision. So, you've got 100% of your capital and you're saying, now let's make a compromise. Let's invest some of that in convergent models with less diversification and rely on that stability, that predictability during those times that trend following regimes are poor and trend following suffers. But what I'd say is, sitting in the back of my mind, I'd say, God, I've just compromised the ability to diversify further with smaller bets across more markets by making that decision. I'm compromising these tails, these outliers that potentially have unlimited magnitude. I'm compromising that for this small sort of extra nudge I'm getting from possibly convergent regimes sort of over a time period I'm uncertain about, because I don't know when that convergent regime is going to end. And when convergent regimes end, it's usually very painful. And I'm going to be introducing further risk into my portfolio that, I hadn't experienced with my trend following models, I think it's a recipe potentially for disaster. It's not to say it can't be done. I'm sure people have done it. A lot of people do it. But I'm just saying, in the back of my mind, that'd be the queries and the concerns I'd have that would be running through my mind as that decision was being made.
Yeah, you're correct in that when you are trying to make convergent systems, you will almost always end up with a very difficult decision about leverage. And most of the time, you will feel uncomfortable with that, more especially much more if you come from the trend following world. In that you're just right. And I think even if you're not using leverage and you're buying and holding something like the S&P 500, which went 80% down on the 30s, you're also having a huge problem of allocation, as you say.
I saw a good trade the other day, a non-trend following trade that I was very intrigued by. I don't know if anybody saw this trade, but I've given you guys some hints into how some of my little special sauce I add. And one of them is that I look at the ATR and the price of the market before I do a short. So since I'm bound with this ATR thing, and as Absolute has sort of said, this ATR really gets in the way of juicy short trades. You're only going to have on a certain position because the ATR is large, for instance, and let's say the short you're in, it goes to zero, you're not going to make much money. So I have a tendency to understand that and proceed accordingly on some of these short trades by either not doing them or whatever. So I did see a good trade the other day, kind of the opposite of all that, where the ATR was so high that I was attracted to this trade because the market had been going down so much. And basically, my stop loss, if I had have bought this downtrend, the market could go to zero, and it would still be less than my 15 basis points that I wanted to lose. And it was the UK Nat Gas. And I was looking at a continuous chart. I might have looked at the contract as well, but I was thinking I should just buy this because if it goes to zero, it's still not going to be as big a loss as I normally take. So I'm just getting long at the lows, and I have zero as my bound here, and I'm not going to. But then I got afraid because, wait a second, I think I've seen markets go below zero. And I think someone mentioned in the news or on Twitter that some natural gas recently, maybe that one, had gone below zero somewhere. So I was afraid and I didn't want to do it. So I think, yes, it's no accident probably that Richard's an accountant. I'm from an accounting background. All of us accountants, you throw us into this trend following world, and you don't be surprised if we're going to be super cautious, right? I made a joke the other day that, just a joke, so don't anybody freak out, that if you tell quants about trend following, it's like handing a gun to a child. Someone's going to get shot, someone's going to die, and they just don't know how to handle. Well, we have our downside too. Maybe we're a bit too conservative and afraid of risk.
I'll say it's just you're not giving a gun to a child. You're giving a big caveman club.
So Jerry, to comment on your nat gas trade, where your stop loss would be just a zero, and this is how you can view a lot of investments with a big asymmetrical risk reward payout. And this scenario is how a lot of value investors and buy and hold investors, in some sense, mimic trend followers in terms of the asymmetry of the maximum loss versus maximum payout. And so one example I would give right now that's still existent and that has been existent for the last 10 years is Bitcoin. You can enter into a buy and hold trade in Bitcoin right now where your stop loss would be zero. And there could be the odds of it happening could be 50% or even 70% that it goes to zero. And you can enter it with such a size as a percentage of your portfolio or your net worth, where you're completely prepared to accept the stop loss at zero. and then let it rip and let it run to the upside, where the upside is unlimited. And for Bitcoin, especially compared to other asset classes, now again, we're talking if you're ideologue, and this is where the conversation goes, if you understand the world and what things mean and whatever. So you can present a case where Bitcoin could go to 100x or 1000x or even more from the current price. So the current price, there are markets in which the current price is a tiny, tiny small loss compared to your portfolio, if you size it correctly, or you compare it to your net worth. And the upside is the trend. And moreover, the upside is the trend in which all possible price scenarios are allowed if you don't even put a trailing stop loss. So you can allow yourself to put a much looser pants stop loss in terms of trailing it. So if you get in now where X is your maximum loss, is your stop loss, but you're not shooting for 3x or 6x, you're shooting for 100x or 1000x, you can allow yourself to go through 3, 4, 5, or 6 drawdowns of 50% or 60% on more on open capital, just like you do with your loose pants model. But that's still just one small little trade, one little exposure when you entered it, and then you just let it rip. So in that sense, I would compare buy and hold of such markets and such instruments as a simple one trade, part of your longer and wider trend following mindset about the world and the universe, in which you don't have to trend follow those markets. You don't have to trend, you can, and you can do both, and they will be uncorrelated. So you can have Bitcoin as a market or a market like that in your portfolio, trade it with your trend following model, fine. But you can also have it as a part of your wider view of the world, even as part of your portfolio, but as just a single trade, which is more like a buy and hold with a huge loose pants allowance, in which your trailing stops, you maybe even take some of it out. You take a quarter out or a third out, but let the rest rip, let the rest rip. And that's completely mimicking the trend following outlier models, because we know the asymmetry of prices where zero is a stop loss. There is a basic asymmetry, and it's even better because you can't go through the stop loss. I mean, especially for markets like that, zero is the bottom. You lose it all, and that's it. So the market can't even gap up through your stop and lose more than what you're risking. So in such sense, trades like this and concepts like this are even more conservative from a trend following mindset than trading it through a system with stop losses, which market can go through or not, and you activate. So what is your comment on this?
Oh, my comment is I have heard Howard Marks pretty much say the same thing, or read his papers, and his newsletters that he sends out. He's kind of said the same thing about how he approaches, and he can get into some nice trades. Basically, that if it goes to zero. But as you were speaking, I immediately thought of one problem with this idea. And then as you kept going, I thought of a second problem, but it's both related. And that is, once again, I'm not saying you don't do it. I'm not saying, I'm just saying that you got to take into consideration futures versus cash. It can go below zero. And if you can lose more than your stop loss on the spreading and rolling the contract forward because it's a future. Now, cash, super safe. Futures, a little bit of a different ball game.
Yeah, no, I'm talking about cash, buying outright Bitcoin, and moreover, it protects you from many other scenarios. You just buy it, take it to cold storage, just own it, and forget about it. You forget you own it, basically, done. You
Right.
buy it, keep it, and you're gone. You don't trade it. You take it to cold storage, take it safely, and then whatever happens to the world, it either goes to 0, 50% chance, or it goes to 100x, 1000x, which is another world in which you're happy you have it. So in that sense, it's a very, very conservative trade.
Right. If you can do it in the cash, I agree. And I think you should be able to. I can run a screen on stocks, and I'm sure that there are some like that. It would be interesting to see. The sample size would be low, but it'd be interesting to see how it performs versus, well, I guess there's not that. It's probably not fair to say how it would perform against trend following, but you'd have to. It'd be interesting to see how much money it's actually made.
Well, no, this is, I wouldn't, I don't think, so this is where we go into ideology versus pragmatism. And I think the division, and when Richard was talking and Michael was talking, I think that the dichotomy between ideology and pragmatism can be also compressed to the dichotomy between high time preference and low time preference. I don't know if you're familiar with the Austrian economics and Mises concept, where pragmatists are more focused on the enjoyment and short-term outcomes and results, and the ideologues are more concerned about longer-term outcomes and results, and they have a lower time preference. They're ready to suffer short-term pain and underperformance or punishment, but their ideology is telling them that over the long run they will come ahead. So I would compare that almost like wisdom and stupidity. I mean, if you're wise and you start learning about more deeper and wider concepts about the world and around you, you become an ideologue. A pragmatist doesn't understand an ideologue because pragmatist never digs deep enough or wide enough to understand why he's doing what he's doing. His time frame is too short. His appetites are short for today, for tomorrow, for next week. So, and then, but over the long run, he then ends up being at a spot where he doesn't know why he's there. So here we're talking about society, economics, philosophy. The leftist versus the rightist. Socialists are pragmatists. Oh, it's very useful. There's a poor guy. Let's hit the rich guy with a brick and give the money to the poor guy. It's pragmatic. Look, society is better now. But an ideologue says, no, there's such a thing as called a golden rule. And maybe for today or tomorrow, it looks like it's a good idea, but over the long run, society falls apart if you do that. So, and it's the same thing with trend followers and shorter term. So there is a wider aspect of this. And how I don't know how I'm connecting this with, with the trade. So here, why we can't just apply the same systematic thing, like you say, oh, let's just look at cheap stocks and see if it works better than trend following. That's not even the point. The point is that from a ideological standpoint, there are certain things, and they may be rare, just like outliers are rare in trend following, right? They don't happen often. But opportunities for assets and markets, whether it's a stock, whether it's Bitcoin or something, they may happen 2 or 3 times a decade. But you as an ideologue, if you dig deep enough and wide enough, you understand the value, you understand the asymmetry of their potential, then you enter them. And people say, oh, he's blindly believing in this. You never should blindly believe in a hold in a market. But if you apply philosophically the same trend following concepts to the context of your overall portfolio, of your overall next exposure to the world, you're doing your own thing. You don't care what the other guys are telling you. It's like a trend follower will say, no, you never just buy and hold. Never say never. You can be ideologue from a different perspective, but you can apply the same philosophical concept that the same trend follower is doing. You can just never explain it to him or a systematic trader. That's why it's always good to dig deeper and wider. Never just hold to one dogma. Never say never. You should keep your mind open. So with this kind of example, so for me, Bitcoin has been a no-brainer for the last 10 years. I mean, I don't know. So I am an ideologue about it because I believe in Austrian economics. I believe in voluntarism. So when it happened, it was immediately clear to me what it can do to society and to the world. So from the ideological perspective, I found it. But then I also married that with the trend following perspective, where assets like this, which come very rare and will be very volatile, which 99% of the population will not be able to hold on to or trade or even buy and hold, because Bitcoin has gone through 70 plus drawdowns 4 times over the last 10 years. Rare are those people who can hold through those drawdowns, maybe add or whatever, or allocate. But if you approach it from a risk perspective, so human nature, oh, this is a great idea. You convince me I'm going to go all in. Well, yeah, if you go all in, you're not going to hold on to it. You're going to be kicked out. So there is a middle way. There is a way where you can accept a certain asset as an ideology, but risk allocate to it amounts for which will make the stop loss of 0 just another trade in your portfolio or in your life. So this is how I see it.
Jerry, is it possible that you repeat that trade in natural gas? Was that the Henry Hub contract, and what type of ATR were you using?
Well, it was the UK Nat Gas continuous contract. And I think if I took the price and divided it by the ATR, then it was 4 or 3 or something. It was something very, very low number. If it went to 0, it was going to be less of a loss than I had taken before. You know, the absolute. You should tweet or send me something on that, on what you just said, because that was pretty good. I liked all of that. I liked the part. I don't want to get into the politics and stuff, but I did like the first part, especially when you were describing the trading of pragmatists and ideologues. That's really insightful. And I think that's so true, you know, that if we have a problem, let's just get rid of it. Like, we have too much volatility, let's do something. Do we all agree? Yes, we all agree. Okay, full speed ahead. And that's what I think the ideologues are pushing back on, which is, yeah, I do think volatility and drawdown is a problem, but I don't want to do it that way. And I want to think about it a little bit more. And like Oleg was saying, I don't want to enrich, you know, sometimes doing something is worse than doing nothing. And I don't want to do that. So I do think that mindset is driving us deeper into these two different camps that we have. I'm not sure what camp I was in or how I thought when I went to work for Richard Dennis, but I was pretty shocked at how certain people thought much differently about life in the world than I did. And I became an instant convert to doing things the right way, the hard way, do the hard thing, do the right thing. And trading is hard. Trading should be difficult. It's not going to be kind to us and give us what we want on a daily or monthly or weekly basis. It's going to be painful. But all right, I'm going to go out and get some more coffee, walk around New York City a little bit. And we didn't pick up on Kelly. Next week, let's talk about Kelly. I don't know if we solved all the Kelly issues. That's a pretty interesting topic. I got off track, one of my tweets. I wasn't helping the cause, but I think picking up Kelly next week might be a good idea. And okay, everybody have a good weekend. Happy trading, and follow everybody on Twitter, and you can keep up with a lot of fun during the week as well. Take care, everyone.
See you, everyone. Bye.